If you wanted to see, true software level growth in the second quarter of 2026, you didn't look at a tech incubator in Silicon Valley.
Right, definitely not.
No, you looked at a 240-year-old traditional bank headquartered in Charlotte, North Carolina.
Which is still wild to even say out loud.
Yeah, it really is. Welcome to this deep dive where today's mission is the Talk Tickers special. We are tearing into Bank of America's Q2 2026 earnings call, ticker symbol BAC.
And we are stripping away all that standard corporate fluff today.
Exactly. We're delivering a data-forward, plain language breakdown of a quarter where a legacy behemoth, a bank with $3.5 trillion in assets just posted a 34% jump in earnings per share.
Which is just a staggering figure.
Right. So whether you currently hold Bank of America in your portfolio or you're just sitting on the sidelines trying to decide if the banking sector is flashing a buy signal, our goal today is to give you the unvarnished mechanics of how these numbers were actually achieved.
Because it's a quarter that fundamentally challenges how we model mature financial institutions. When you analyze a legacy bank, the expectation is stability.
Yeah, you expect it to be boring.
Exactly, boring. You model for single-digit growth, a predictable dividend, and a business that roughly tracks broader GDP.
Right.
You do not model for a mature trillion-dollar balance sheet to suddenly expand its bottom line by more than a third in a single year-over-year period.
You really don't.
So our job today is to look at the architecture of that growth. We need to figure out if it is sustainable or, just a temporary anomaly.
Okay, so I am looking at the raw scoreboard here, and the first thing that jumps out to me is just the sheer scale of the cash flow. Top-line revenue came in at $31.6 billion.
Yep, mass.
And that is a 15% increase compared to the second quarter of last year.
Right.
Now, for a retail investor who might be used to looking at, say, mid-cap growth stocks, 15% might sound pretty standard.
Sure, it sounds normal in tech.
But we need to contextualize what a 15% move means on a base of tens of billions of dollars, right?
Oh, absolutely. It requires a monumental shift in capital velocity. Think about it. When a startup goes from 10 million to 11.5 million in revenue, they achieve 15% growth by, perhaps landing 2 new enterprise clients.
Yeah, a couple of good sales calls.
Right. But when Bank of America adds over $4 billion in new quarterly revenue to hit that $31.6 billion mark, they are capturing a macro level shift.
A shift in how the whole economy is moving its money.
Exactly. You are looking at the aggregate financial activity of millions of consumers and thousands of corporations accelerating all at exactly the same time.
And honestly, the net income numbers reflect that acceleration perfectly. Net income hit $9.1 billion, which is up 27% from the previous year.
And that flows directly down to the bottom line.
Yeah, directly to the metric that dictates shareholder value earnings per share, which landed at $1.21.
That is that 34% massive jump we talked about at the top of the show.
Right. And I want to spend some time on the mechanics of that 34% because instinctually, I get suspicious.
Sure, you should be.
Like when I see a highly regulated, capital-intensive business suddenly spike its EPS that aggressively, my first thought is to look for the accounting trick.
Did they release a massive reserve?
Exactly. Did they sell off a subsidiary? It's like watching a cruise ship accelerate like a speedboat. How do you physically generate a 34% earnings jump without some sort of one-off gimmick?
Well, it is the right instinct to be skeptical. But when you parse this specific income statement, you see that the growth is entirely operational.
So no accounting magic.
No accounting magic. There is no one-off asset sale artificially inflating the bottom line here. To understand the how, you really have to recognize that a money center bank of this size operates 2 distinct massive engines.
Okay, let's break those down.
Sure. So you have the consumer and commercial banking side, we'll call that Main Street. And then you have the capital markets and advisory side, which is Wall Street.
Right. Main Street and Wall Street.
Yeah. And historically, these 2 engines are countercyclical.
Meaning when one is booming, the other is usually dragging, right?
Precisely. If interest rates are high, Main Street banking usually profits from wider loan margins.
Because they can charge more for loans.
Right. But Wall Street suffers because high rates choke off corporate borrowing, mergers, and acquisitions. People don't want to do deals when money is expensive.
That makes sense, and vice versa.
Exactly. If rates drop to near zero, Wall Street booms with cheap debt issuance, But Main Street suffers because the bank can't make any money on standard loans.
So what does this 34% EPS growth actually signify then?
It signifies the incredibly rare environment where both engines are firing at maximum capacity simultaneously. They basically widen the gap between revenue and expenses on both sides of the house.
Wow. Okay, let's actually look under the hood of those engines, starting with Main Street.
Good place to start.
So the core metric here is net interest income, or NII. That came in at $16.2 billion for the quarter, which is a 9% year-over-year increase.
Right, 9%.
We should really drill down into the mechanics of NII because it is the fundamental bedrock of traditional banking.
It really is. So NII is simply the spread between the yield the bank earns on its assets like mortgages, auto loans, and commercial credit, and the cost of its liability.
The liabilities being the deposits they hold for customers, right?
Exactly. So hitting $16.2 billion in net interest income means they are actively widening that spread. They are charging more for capital than they are paying to acquire it.
Right.
But the real story isn't just the aggregate number. It is how they are sourcing the liability side of that equation.
Okay, right. The deposits. Because the transcript notes that average deposits are up to $2.02 trillion.
$2 trillion. Just an incredible amount of money.
But the most revealing data point, in my view at least, is the composition of those deposits. They reported a 4% growth specifically in non-interest-bearing accounts.
Adding $19 billion to those balances.
Right. And I really want to pull this apart because, honestly, this defies basic economic logic at first glance.
How so?
Well, we are in a relatively high interest rate environment. Every financial app, every brokerage on your phone is relentlessly marketing 4 or 5% yields on cash right now.
Oh, yeah, you see the ads everywhere.
Everywhere. So why on earth is Bank of America successfully pulling in an additional $19 billion that costs them absolutely 0% in interest? Who is leaving that much money on the table?
It definitely seems counterintuitive if you only view banking through the lens of a retail consumer chasing yield.
Right, like me trying to get 5% on my savings account.
Exactly. But you have to look at the structural realities of corporate banking and treasury management. A large portion of those non-interest-bearing balances are corporate operating accounts.
Okay, so business money.
Right. If you are a middle-market manufacturing company running a $50 million payroll, you do not move your operating cash to a high-yield online savings account. The friction is simply too high.
Because that cash needs to be instantly accessible, right?
Yeah.
For vendor payments, tax remittances, daily liquidity.
Exactly. Bank of America captures and holds these zero-cost deposits because they are providing the underlying software and financial infrastructure that these companies use to literally survive.
Ah, so it's a service trade-off.
Right. They provide the ERP integrations, the secure payroll routing, the foreign exchange clearing. The company leaves tens of millions of dollars in a non-interest-bearing checking account because the operational value of Bank of America's treasury services far outweighs a few percentage points of yield.
And Alistair Borthwick, the CFO, explicitly noted this dynamic on the call, didn't he? They aren't competing for hot money.
No, they really aren't. They aren't in the business of fighting for rate-sensitive, transient deposits.
Which is an incredibly powerful competitive moat when you think about it.
Oh, it's massive. Think about the math. If an online bank wants to attract $19 billion in deposits today, they have to pay out roughly $950 million a year in interest just to get it.
Wow. And Bank of America attracted that same $19 billion for free?
For free. Because they own the relationship and the infrastructure. They take that free capital, lend it out at commercial rates of 6 or 7%, and that entire spread drops directly to the NII line.
That is incredible. And that is exactly how you drive a 9% increase in net interest income.
Precisely.
But it also extends to the retail side too, doesn't it? Because they mentioned they recently refreshed their consumer rewards program.
Yeah, and they enrolled over 2 million new customers since late May alone.
Just since May, that's huge.
It is. And for a retail consumer, a primary checking account is incredibly sticky. I mean, once your direct deposit is set up, your mortgage auto pay is linked, and your credit card rewards are tiered based on your banking relationship, you are highly unlikely to switch banks.
Yeah, I mean, the switching costs, just the time and hassle of untangling your whole financial life, it's just too high.
Most people won't do it. So those retail checking accounts also act as a massive pool of zero cost or extremely low cost capital for the bank.
So the Main Street engine is behaving exactly as you'd want if you're a shareholder. They are aggregating trillions in low-cost deposits through corporate infrastructure and retail stickiness and lending it out profitably.
Which gets us that $16.2 billion in NII.
Right. But as we established earlier, that alone doesn't trigger a 34% jump in EPS.
No, it doesn't.
We have to look at the other side of the house.
Yeah.
The Wall Street engine.
The fee-based businesses.
Exactly.
Yeah.
So non-interest income was up 22% overall. But the granular data is what really tells the story here. Investment banking fees exploded by 50% year over year.
Up to $2.1 billion.
Yeah. 2.1 billion. That's a huge spike.
And that 50% jump is the clearest indicator we have that the capital markets have fundamentally thawed out.
Because they've been frozen for a while, right?
Exactly. For the last couple of years, corporate boardrooms were effectively paralyzed by macro uncertainty.
Yeah, everyone was terrified of the Fed.
Right. They were asking, is the Federal Reserve going to hike rates to 7%? Are we entering a deep recession? Will inflation reaccelerate?
And when executives are paralyzed like that, they just sit on their hands.
They do. They don't issue new debt. They don't take their companies public, and they definitely don't acquire their competitors.
The pipeline just sits there, backing up.
Exactly. But as the U.S. consumer proved incredibly resilient and the economic data stabilized, that paralysis just broke.
People realized the sky wasn't falling.
Right. Corporate America realized that the current rate environment might actually be the new normal, and they could no longer afford to just wait around.
Especially the companies that took on cheap debt back in 2020 or 2021.
Oh yeah, they are now hitting the maturity wall. They have to refinance, which means they have to issue new bonds.
And private equity firms need to return capital to their limited partners too.
Which means they have to sell portfolio companies or take them public. And here's the thing. Every single one of those transactions requires an underwriter.
And Bank of America stepped right in to take a huge piece of that pie.
They captured a massive share of that unleashed demand, and that's what drove that $2.1 billion in advisory and underwriting fees.
Okay, so that covers investment banking. But we also have to look at the sales and trading division.
The trading desks.
Right. They posted $7.2 billion in revenue, which is a 33% increase.
Another massive number.
And Brian Moynihan, the CEO, he made a real point on the call to highlight that this was their 17th consecutive quarter of year-over-year sales and trading revenue growth.
17th, that's over 4 years.
Right. And I really want to unpack why 17 quarters is such an anomaly. Usually a bank's trading desk is the most volatile line item on the income statement, isn't it?
It is traditionally highly cyclical. I mean, trading revenues usually spike during periods of massive market volatility.
Like the initial weeks of a geopolitical crisis or something.
Exactly, or a sudden monetary policy shift, because clients are scrambling to hedge their portfolios. But when markets are calm and just steadily drifting upward, trading revenues typically collapse because transaction volume just dries up.
So how is Bank of America engineering consistent growth for over 4 years, regardless of whether the VIX is at 12 or 35?
By fundamentally changing the nature of their trading operations.
What do you mean?
Well, historically, a lot of Wall Street trading revenue came from proprietary trading. That's the bank taking its own massive directional bets on the market.
Which is super risky.
Inherently volatile. What Bank of America has built instead is essentially a financing and market-making machine. They aren't betting on whether the S&P 500 goes up or down.
Okay, so what are they doing?
They are providing the liquidity and the margin financing for massive institutional clients. We're talking pension funds, sovereign wealth funds, quantitative hedge funds who are making those trades.
Ah, I see. They're acting as the toll booth and the financier rather than the gambler.
Exactly. Equities trading alone delivered a record $3.6 billion, up 70%.
Wow.
Yeah. When you provide prime brokerage services, lending securities to short sellers, providing leverage for hedge funds, executing complex derivatives contracts, you collect fees and financing spreads regardless of the market's ultimate direction.
So it doesn't matter if the market is up or down, they still get paid.
Right. Building a machine that can post year-over-year growth for 17 straight quarters implies they have achieved massive scale in client financing. It insulates them from the traditional boom and bust trading cycles.
Okay, so we've established that both engines are roaring right now. Main Street is gathering cheap deposits. Wall Street is printing advisory and trading fees.
They're both firing.
But here is the crux of the entire quarter. You can grow revenue by 15% all day long. But if your costs increase by 14% to support that growth, your earnings per share barely budge.
Right, growth isn't free.
Exactly. So the mechanism that actually forced that 34% EPS explosion is what management calls operating leverage.
The holy grail for a bank.
Right. They generated 6.6% operating leverage for the quarter, improving their efficiency ratio to 59%.
Which is a fantastic ratio for them.
We really need to translate this because it is probably the most critical concept for the retail investor to grasp today.
Operating leverage is the ultimate measure of corporate scalability. Mathematically, it is simply the difference between the rate of revenue growth and the rate of expense growth.
Okay, to put a specific visual on it for you, you think getting a raise at work. Let's say you get a 15% raise, but your rent, your grocery bills, your car payment, they all stay exactly the same.
Your fixed costs don't move.
Right. So that extra cash from your 15% raise doesn't get eaten up by new expenses. It goes straight to your bottom line, directly into your savings. Or think about running a massive manufacturing plant.
Sure.
Your fixed cost, the mortgage on the building, the electricity, the base salaries of your floor managers are already paid for. If suddenly you get 15% more orders, you don't need to build a second factory.
Right, you just run the machines a little longer.
Exactly. The cost of fulfilling those new orders is marginal, meaning almost all the new revenue from that 15% increase drops straight down to your bottom line as pure profit. The factory is already built.
That is a perfect analogy. Bank of America grew their top-line revenue by 15%, but they held their operating expenses incredibly flat.
Which is hard to do.
Very hard. The cost of running their quote-unquote factory barely changed. So practically every new dollar of that $31.6 billion in revenue went straight into the profit column.
But the deeper question is, in an inflationary environment where wages, software licenses, and real estate are all getting more expensive, how did they physically manage to keep expenses flat while handling 15% more business volume?
And the transcript gives us a very specific and kind of surprising answer.
Yeah, it wasn't through massive layoffs or closing thousands of branches.
No, not all.
It was through technology and specifically the integration of artificial intelligence.
Yeah, AI is driving the bus here.
Now, I have to be honest. I am usually the first person to roll my eyes when a legacy company starts throwing around the term AI on an earnings call.
Oh, everybody's doing it right now.
9 times out of 10, it is just buzzword compliance to try and get a multiple expansion on their stock. But Bank of America provided incredibly granular, measurable data on their AI deployment here.
The specificity is what separates the reality from the hype here. I mean, they reported having over 200,000 employees actively using AI-enabled tools.
Generating 400,000 prompt requests a day.
Let's contextualize that for a second.
Please do.
400,000 times every single day. A Bank of America employee is delegating a task to an AI model rather than doing it manually.
That's a massive amount of automated labor.
It is. They specifically detailed 114 live generative AI use cases actively running in production right now.
Okay, but what does that actually look like in practice? How does a generative AI use case mechanically translate into 6.6% operating leverage?
Well, it attacks the most expensive bottleneck in traditional banking.
Which is?
Human hours spent on low-value data aggregation. Let's look at a corporate relationship manager, for example. Historically, before a pitch meeting with a Fortune 500 client, that banker, or more accurately, a team of junior analysts would spend dozens of hours pulling SEC filings.
Right. Grunt work.
Internal credit models, market news, historical transaction data, just to manually assemble a briefing book.
So you have a highly paid analyst spending days essentially doing advanced data entry.
Exactly. With the generative AI models Bank of America has deployed, that workflow is condensed from days to minutes. The AI instantly aggregates the disparate data sources, synthesizes the risk models, and generates the briefing documents. The human banker then reviews and refines it rather than building it all from scratch.
So the output per employee radically increases. You don't need to hire 10 new analysts to handle a 50% jump in investment banking volume.
No, you just empower the existing analysts with AI copilots.
And it extends across every division too, doesn't it?
It does. Their software developers are using AI for code generation and debugging, dramatically speeding up the deployment of new digital banking features.
Right.
Their wealth management advisors use it to instantly summarize portfolio performance and generate personalized client communications.
And even on the retail side, they have their virtual assistant, Erica.
Right. Eric is handling millions of routine customer service inquiries. We're talking address changes, transaction disputes, balance checks.
Things that previously would have required a human call center agent sitting in a cubicle.
Exactly. They noted Erica now has over 24 million active users.
24 million? That's insane.
It is. And every time Erica resolves a query without routing it to a live human, the marginal cost of servicing that customer drops to near zero.
So that is the physical mechanism of the operating leverage.
Yes. When you deploy 114 different AI solutions across an enterprise of 200,000 employees, you are systematically shaving minutes and hours off of millions of microtasks every single day.
It fundamentally alters the cost structure of the bank.
It really does. It allows them to process a 15% surge in top-line revenue without expanding their headcount at all.
It is a remarkable pivot. We're essentially watching a 240-year-old financial institution rewire its central nervous system to operate like a SaaS company.
That's a great way to put it.
However, I want to step in here and forcefully stress test the bullishness.
Okay, let's do it.
Because whenever I see a bank print a 34% jump in earnings, my immediate fear is that they are juicing the numbers by loosening their underwriting standards.
Taking on bad risk.
Right. The easiest way for a bank to show fast growth is to lend money to people or businesses who probably shouldn't be borrowing it. You take on more risk today to inflate revenue, and you pay for it tomorrow when those loans inevitably blow up.
It's happened a million times before.
So, looking at the credit quality data in this quarter, what is the actual risk profile here?
Well, it is the most vital question to ask, especially when evaluating operating leverage. If they cut costs by understaffing their risk management division, that 34% EPS jump is just a mirage.
Exactly.
But the credit metrics here show remarkable discipline. Their net charge-offs, which are the actual loans they had to write off as uncollectible, stayed perfectly stable at $1.4 billion.
Okay, so that didn't spike. And what about their provision for credit losses? That's the capital they proactively set aside in anticipation of future bad loans.
That also remained stable at $1.4 billion.
So they aren't seeing a wave of defaults coming.
Correct. They grew their average loan book to $1.2 trillion, which is an 8% year-over-year increase, without any commensurate spike in credit degradation.
That's pretty impressive.
It is. And we have to look at the macro data supporting that stability. CEO Brian Moynihan provided specific insights into the U.S. consumer drawn directly from the massive proprietary data set they have.
From all their credit card and checking account flows.
Right. And consumer spending in the second quarter actually accelerated, running at a 6% year-over-year increase.
See, that is a fascinating data point because it runs highly counter to the prevailing macroeconomic narrative right now.
It totally does.
I mean, if you turn on financial news today, the dominant storyline is that the U.S. consumer is exhausted, savings are completely depleted, and spending is just stalling out.
That's all you hear on TV.
But Bank of America's hard data, the actual dollars flowing through their network, says consumers are spending 6% more than they did last year.
It highlights the difference between consumer sentiment and consumer behavior.
What people say versus what they do.
Exactly. People might tell survey takers they feel pessimistic about the economy, but their transaction data shows they are still employed, their wages are still growing, and they're still spending on travel, dining, and services.
Right.
Furthermore, their consumer credit card charge-offs and delinquencies actually improved this quarter.
Okay, so the consumer's holding up nicely, but I want to press you on the commercial side, specifically commercial real estate, or CRE.
The elephant in the room.
This has been the massive looming shadow over the entire banking sector since 2023. We know that structural shifts in remote work have just decimated downtown office valuation.
Wow, absolutely crushed them.
Regional banks have been destroyed by it. So how is Bank of America exposed here? The transcript briefly mentioned that CRE issues were offset by, quote, isolated improvements elsewhere, but that feels like management just hand-waving away a very real risk.
It is a fair pushback. But we need to separate Bank of America's CRE exposure from the regional banks that are truly suffering right now.
Okay, what's the difference?
Well, the regional banks often hold highly concentrated portfolios of Class B and Class C office space in secondary markets with very aggressive loan-to-value ratios.
The older, less desirable buildings.
Right. Bank of America's commercial real estate portfolio is structured differently.
How so?
First, it is a much smaller percentage of their total $1.2 trillion loan book. Second, the composition is entirely different. They are heavily weighted toward multifamily housing, industrial logistics centers, and Class A premium office space.
The nice stuff.
Yeah, the buildings that have held their value much better than older commodity office buildings. More importantly, their underwriting standards have historically demanded significant equity from the borrowers.
Meaning the building owner has a lot of their own cash tied up in the deal.
Exactly. If a building's valuation drops by 20%, but the borrower originally put down 40% equity, the bank's loan is still fully covered by the collateral.
Ah, so the borrower takes the loss, not the bank.
Right. Management noted that their total criticized commercial exposures, those are the loans that are showing signs of stress and require closer monitoring, actually declined by $2.3 billion in the quarter.
Oh, wow. So it's actually getting better.
Yeah. So while CRE remains a macroeconomic risk, Bank of America's specific balance sheet has absorbed the valuation shocks without threatening their core capital.
All right, so the retrospective analysis here is incredibly clean. The Main Street deposit engine is gathering cheap capital. The Wall Street engine is executing at a 17-quarter high. AI is holding expenses flat, and the credit risk is heavily mitigated.
It's a great setup.
But the stock market does not price equities based on the rearview mirror. It is a forward-looking mechanism.
Always looking ahead.
So we need to transition into management's guidance. What are they modeling for the back half of 2026?
Well, they are projecting sustained momentum to the point where they actively upgraded their full-year guidance on several key metrics.
Upgrades are always good.
Let's look back at net interest income. They initially guided investors in January to expect 5% to 7% growth for the year.
Okay.
In April, they revised that upward to 6% to 8%.
And coming out of this Q2 report, they stated they now expect to hit the upper end of that 6% to 8% range.
Which is a massive show of confidence in their treasury management and loan pricing models.
It really is.
And they were equally aggressive on their operating leverage forecast too. Historically, their target has been to generate about 200 basis points of operating leverage annually.
Let's define basis points quickly for you if you're listening. A basis point is 1/100th of a percent. So 200 basis points means a 2% expansion in their operating margin.
Correct. But after generating an explosive 450 basis points of operating leverage in the first half of this year, they raised their full year guidance to a range of 300 to 400 basis points.
I want to stop right there and dig into the math of that guidance, because this is where a retail investor really needs to read between the lines.
Okay, let's look at the math.
If they achieved 450 basis points in the first half of the year, but they are only guiding for an average of 300 to 400 for the full year, the math basically mandates that the second half of the year is going to be significantly weaker.
Right. They're forecasting a deceleration.
So my question is, are they sandbagging? Are they intentionally under-promising for the next 2 quarters so they can easily beat expectations and look like heroes? Or is there a structural reason the back half of 2026 is going to be harder?
It is a critical distinction, and it was actually the focus of some really intense questioning from the institutional analysts on the call.
I bet it was.
The answer comes down to the mechanics of year-over-year comparables, or comps. It is less about the business slowing down and more about the baseline getting significantly tougher.
Explain the mechanism of a tough comp for a bank of this size.
Think about it like a runner tracking their year-over-year progress. In the first half of 2025, Bank of America's performance was relatively sluggish, capital markets were still somewhat frozen, and loan growth was moderate.
Right.
So when they ran the race in the first half of 2026, it was mathematically easy to post a massive 450 basis point improvement over that slow baseline.
The hurdle was basically resting on the ground.
Precisely. But in the second half of 2025, their business actually started to accelerate. The investment banking pipeline opened up and their net interest income swelled.
Ah, I see where this is going.
So the baseline they are comparing themselves against in the next 6 months is dramatically higher. The hurdle just got raised by 3 feet.
Got it.
If they execute flawlessly and put up the exact same massive absolute dollar amounts in Q3 and Q4 that they just did in Q2, the percentage growth will mathematically compress because the denominator last year's performance is so much larger.
So they aren't projecting a collapse in the business fundamentals at all. They are just acknowledging the mathematical reality that maintaining a 4.5% margin expansion over a rapidly strengthening historical baseline is highly improbable.
Exactly. Borthwick, the CFO, was very clear about this. If they print another $2.1 billion in investment banking fees in Q3, it won't register as a 50% year-over-year jump because the back half of last year was already strong.
Makes total sense.
So the 300 to 400 basis point guidance isn't sandbagging. It is a mathematically realistic projection of continued strength against a tougher comp. And frankly, 300 to 400 basis points is still double their historical target.
We also have to look at the macro assumptions underpinning this guidance. They aren't building these models in a vacuum, right?
Oh, definitely not.
Bank of America has one of the largest economic research divisions on Earth feeding data into these forecasts. So they officially raised their 2026 U.S. GDP growth forecast to 2.2%.
Up from previous estimates.
But the most impactful variable is their assumption regarding the Federal Reserve. What are they modeling for interest rates?
Their forward guidance assumes exactly one 25 basis point rate hike in September.
A hike, not a cut.
A hike, yeah.
That is a massive divergence from what the market was hoping for at the beginning of the year. But counterintuitively, for Bank of America, a rate hike is actually a tailwind, isn't it?
It is, due to a dynamic called asset sensitivity.
Break down the mechanics of asset sensitivity for you listening. Why does a bank want rates to go up?
When a bank is asset sensitive, it means the yield they earn on their assets, their floating rate commercial loans, their cash parked at the Federal Reserve, their new mortgage issuances reprices upward faster than the interest they have to pay out on their deposits.
Because, as we discussed earlier, $19 billion of their new deposits are sitting in non-interest-bearing corporate accounts. The cost of those liabilities doesn't change, even if the Fed hikes rates to 8%.
Exactly. Their cost of capital is incredibly sticky and slow to rise, while their loan yields adjust almost immediately.
Meaning they just pocket the difference.
Right. Borthwick stated that a 100 basis point parallel upward shift in the yield curve would increase their net interest income by $1 billion over a 12-month period.
$1 billion in pure income.
Yeah. So baking a 25 basis point hike into their models in September provides a natural mechanical lift to their Main Street revenue engine.
All right, we have systematically disassembled this quarter. We've explored the massive cash generation of the Main Street and Wall Street engine.
I covered a lot of ground.
We really did. We've defined how their AI integration is physically driving operating leverage by automating legacy workflows. And we've unpacked the math and macro assumptions behind their upgraded guidance.
Yep.
So it's time to bring this home. What does this fundamentally mean for you, the retail investor listening right now? We promised an opinionated, actionable stance on this deep dive. Based on the data, what is the verdict?
The verdict is definitively bullish.
No hesitation there.
None. And that bullishness is grounded in two very specific actionable metrics: profitability and capital return.
Okay, let's start with profitability.
The ultimate measuring stick for a bank's efficiency is ROTCE, return on tangible common equity. For Q2, Bank of America hit an elite 17%.
We need to define tangible common equity carefully because it is distinct from just basic book value, right?
It is. Tangible common equity represents the hard physical capital that the shareholders actually own. It is the bank's total equity minus preferred stock and, crucially, minus intangible assets like goodwill.
And goodwill is essentially the premium a bank paid over book value during past acquisitions.
Right. It isn't real cash. It's an accounting metric. By stripping that out, TCE gives you the absolute core liquid net worth of the institution.
So return on tangible common equity measures exactly how much profit the management team is generating using only the hard cash that belongs to you, the shareholder.
Precisely. And generating a 17% return on that capital is phenomenal for a heavily regulated, globally systemically important bank.
It's massive.
But the way they are driving that number up is just as important as the number itself. It isn't just by growing the numerator of the profits. It is by actively shrinking and optimizing the denominator, the capital base.
Balance sheet optimization, how exactly are they doing it?
They are deliberately paying down lower yielding institutional certificates of deposit and repurchase agreements.
Walk us through the mechanics of that. Why pay off a CD?
Well, imagine the bank holds billions in institutional deposits that they are paying 4.5% interest on, and they're only able to lend that specific block of cash out at 4.8%.
The spread is tiny. It barely makes any money.
Right. But under banking regulations, holding those assets still requires the bank to tie up a massive amount of regulatory capital as a safety buffer.
So it's just dead weight on the balance sheet.
Exactly. By actively paying those off and letting those low-margin deposits roll off the books, they free up all that regulatory capital.
They trim the fat.
They shrink the bloated, inefficient parts of the balance sheet, which mathematically means their core high-margin businesses represent a much larger percentage of the total pie. That efficiency is what drives the ROTCE up to 17%.
Which proves management is intensely focused on capital discipline, not just growth for the sake of growth.
Absolutely.
But for the retail investor, the ultimate question is how that 17% return actually makes its way into their brokerage account. And that brings us to the final and perhaps most compelling piece of data from the entire call of the shareholder yield.
This is the undeniable bull case right here. In this single 3-month period, Bank of America returned $8 billion to its shareholders.
$8 billion in 90 days.
Yes. They distributed it through a combination of direct cash dividends and massive open market share repurchases.
And we need to understand the mechanics of why buybacks are so powerful at this scale. When Bank of America uses billions in cash to buy its own stock on the open market and retire those shares, it permanently reduces the total number of shares in existence.
The pie gets smaller.
Which means every remaining slice gets inherently larger.
Exactly. Even if the bank's total net income stays exactly the same next quarter, the earnings per share will go up, simply because those earnings are being divided among fewer outstanding shares.
It is a direct, highly tax-efficient transfer of wealth from the bank's balance sheet right into the equity value held by the retail investor.
It really is.
So synthesizing everything we have covered today, let's make this actionable. If you are currently holding DAC in your portfolio, what does the data dictate you do next?
If you own this stock, the fundamental analysis suggests you sit tight and let the machine work for you.
Don't overthink it.
Right. You have a management team that has successfully engineered a 6.6% operating leverage expansion. They have heavily mitigated their commercial real estate risk, and they are aggressively executing an $8 billion quarterly capital return program.
There is no fundamental data point in this earnings call that suggests selling into this strength.
No. Let their AI efficiencies and their share purchases continue to compound your equity.
Okay, but what about the listener who doesn't own it? They are looking at a stock that just posted a 34% EPS jump. Is the thesis that they missed the boat? Is the stock fully priced for perfection here?
I do not believe they missed the boat, because Bank of America currently represents a uniquely balanced macro hedge.
What do you mean by that?
Usually, investing in the financial sector requires you to make a binary macroeconomic bet. You buy a regional bank if you think Main Street lending will boom, or you buy a pure play investment bank like Goldman Sachs if you think Wall Street capital markets are going to surge.
You usually have to pick a lane.
Right. But what this quarter proved is that Bank of America has synchronized both engines perfectly. They are capturing the massive upside of a resilient U.S. consumer through zero-cost deposit growth, while simultaneously printing billions in advisory fees from a hyperactive Wall Street.
So it's the best of both worlds.
If you want exposure to the durability of the U.S. economy, backed by a fortress balance sheet and a massive dividend and buyback program, this remains a highly compelling entry point.
A perfectly synchronized financial juggernaut. It is a rare alignment in the banking sector. As we close out this deep dive, I want to leave you, the listener, with a final thought to mull over. Something that builds on the mechanics we've discussed today, but looks a little further down the timeline.
Into the big picture.
Right. Throughout this entire breakdown, the recurring mechanism driving this massive outperformance wasn't a new lending product or a complex derivative. It was technology.
Specifically, it was the 114 generative AI models actively running inside the bank.
Right. Destroying manual workflows and expanding profit margins.
It is the architectural shift that the market is just beginning to price in.
Now, think about the dominant financial media narrative of the last 10 years. We were relentlessly told that agile, nimble fintech disruptors, the Silicon Valley startups, were going to eat the lunch of these legacy banks.
That was the accepted consensus.
Yep.
The disruptors were going to unbundle the bank.
The thesis was that a 240-year-old bank running on ancient mainframe computers could never compete with a modern tech stack. The legacy banks were supposed to be too bloated, too slow, and too heavily regulated to survive the digital transition.
That's what everyone said.
But look at the empirical data we just dissected. Bank of America has 200,000 employees generating 400,000 AI prompts a day. They have over 24 million active users interacting with an AI financial assistant.
It's unbelievable scale.
If a legacy behemoth with $3.5 trillion in assets can successfully weaponize artificial intelligence to compress their costs, accelerate their workflows, and generate tech-level operating leverage, what is the competitive advantage of a fintech startup?
It effectively neutralizes the startup's primary weapon.
Exactly. AI models scale based on the size and quality of the proprietary data they are trained on. A startup has a fraction of the transaction data that Bank of America possesses.
A tiny fraction.
If Bank of America can deploy AI faster, train it on a massively larger proprietary data set, and instantly distribute it to tens of millions of sticky corporate and retail clients, the disruptors might suddenly find themselves being disrupted by the very legacy giants they were trying to replace.
The cruise ship didn't just turn, it upgraded its engines.
It really did. It is a dynamic that will completely redefine the banking sector over the next 5 years. Thank you all for joining us on this deep dive. Keep questioning the consensus, keep digging into the data, and we will catch you next time.